Good morning, traders. Welcome to the Traders Lab. I am Tom B. Streaming live Monday through Friday, 11:30 through 1 p.m. Eastern Standard Time. This stream is about market mechanics, understanding why the market does what it does, how it does what it does, and shedding light on how you might align with the behavior of the participants in the market. Ultimately, the market's purpose is to find a fair price. It doesn't do that based on a crossover of an indicator. It does it by the interaction between the buyers and the sellers. Ultimately, that is what creates the market. So the objective here is to help you integrate an understanding of these market mechanics and behaviors, which may help you either use your indicators better to try to stay aligned, or perhaps even move on to a different viewpoint of how to operate in a developing market structure. So what we're going to be doing and looking at is how to integrate Bookmap, which is an order flow tool, with auction market theory. Auction market theory is the foundation of how the market works. And the tool we use to view this is something called a volume profile. And a volume profile is not complicated, though it might look foreign. It is really a representation of price and volume, because ultimately it is volume that moves the market and nothing else. So we're going to be looking at that in the intraday developing time frame. And I think of it like a chassis. In other words, what is happening with the interaction between the participants as the day develops? How does it fit in to what has happened previously, structurally, in all time frames? So we'll be looking at it from trading inside out. So the order flow tool allows us to look at more microstructure and behaviors, and then the objective is to overlay the structures in the developing that are happening in the developing time frame to get aligned with the higher time frame, and that's what can create outside opportunity. And of course, it involves taking risk to take advantage of those potential opportunities. General disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Live trading is in simulation demo paper trading mode and strictly for educational purposes. Live trading executed in simulation cannot accurately represent realistic trading performance. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results, and remember, this is not a trade calling room. This is for educational purposes only, to help you get a sense of market mechanics, how the market works, and then if you might be able to integrate that potential insight into your current trade plan, or develop something that might be more representative of the actual behavior of the participants in the market. And I always do this little review. It takes a few minutes, but I think it's worth it, because if you don't understand the basics of the market, how could you ever develop into a more knowledgeable trader? And whether or not you use this in any fashion, it will help you understand why. And the auction is very simple. It's like going to the store. There's a retail price where buyers and sellers interact, which creates high volume, right? A lot of volume. We buy retail, they sell retail. That's an agreement on fairness. If they put it on sale, that price goes down. If you perceive it's below value, you're going to buy it. That's why buyers might be motivated to interact in the market, because they perceive potentially that a price is too low. On the other side of that, if that seller is raising the price and it goes beyond the area that you feel is fair, less buyers are going to interact with that higher price until the sellers run out of buyers at the higher price, and they have to now lower the price to attract a buyer. And this process takes place back and forth, which is what we see in rotations in the market. At some point, there an equilibrium is created, and again, it's retail, where everybody kind of says, okay, this is fair. Now, the thing about it is, the market's job is to find these outside edges in all fractals or time frames. And that is where the profile can be very useful, because we see this behavior at different locations in the market. And you might think, well, overall, it's just going to, where's the low, where's the high of the day, right? Well, in between those extremes of behavior, the market is using the same process in all distributions, or let's call them what they are, consolidations. And when you see a consolidation, what you really have is an interaction between those buyers and sellers. Where's the outside edge on both sides, from the too low, too high? Where's the median price or fair price in that interaction between buyers and sellers? So we are establishing, as we progress through the day, different locations of interaction of different time frame participants, but the process is generic of price discovery. So it's fractal. So I think of it as higher time frame, but we are interacting in more microstructures in an attempt to get aligned for the larger opportunity, should it present itself. And then the other element in this is something called context. And today's a good example of it. And I'm going to explain what happened today, because we have multiple contexts evolving. And they're related to what happened yesterday in the RTH, how we opened today, the early behavior, and what the potential was, and how we might navigate that. And I hope you're all with me. By the way, if you're in YouTube, also thanks for being here. Be sure to click on the cogwheel and make sure you're in 1080p. Also, if you want to review this later for any reason, grab the link in YouTube, save it, and this stream will be available for a replay up until sometime this evening before it becomes removed. So if you have any interest in what we discussed today, it might be useful, but it will not stay beyond this evening. Also, there's a 15-second delay in YouTube, and if you guys post questions, which I welcome you to do in the Discord Trader Lab or in YouTube, I will try to answer questions that apply to the group. And again, thanks for being here, and thanks for visiting the Trader Lab. I'm going to take a look at some higher time frame stuff to kind of give you, because for me it's very important that we understand where we are. Now, if you remember, 4305 was the top of this consolidation, and I'm taking you back so you know how we start looking at things. And in here, this was, remember, we broke out of this consolidation. This was our target around 4215. We trended out. This was our next target up here. Fell back inside. Now we have the beginning of a potential consolidation. And this is the fair price, 42.76. Now, where did we open today? 42.77. That is suggesting that right now the market likes this area because we didn't break away from it. Now I'm going to take you into a little more detail in this, but I want you to see what it's doing. Now it's not exactly clear here, so I apologize for that. But yesterday, the high of the day was 4305-ish, the high of this consolidation. We have an artifact left behind, and I'm going to show it to you, that we have the potential to test, and it's sitting at 4308.25. So today we have the potential, and again, not a recommendation, to come up, take out yesterday's high, check this artifact, and then return back here, or continue higher. And again, nobody knows that part of it. So let's go take a look now at a little more minutia and with a little more detail so you can kind of see how this comes together. Now, in the auction, remember, there's multiple time frame participants. So let's look at this logically, okay? Now, this is FOMC day, okay, so Wednesday. This was our target around, and it was around 43.17-ish, if you guys remember. Now, we went through it, but then we fell back under it, So that looks excessive to me. Okay? Maybe it looks excessive to you. And we reversed, left that wick. So now I'm thinking potential consolidation is going to develop. Now let's look at these pieces. This is the 4308.75. On this day, and this is how auction market theory works, the highest volume on this day, Wednesday, was right here, 4308. And remember, the market tends to check retail prices. If this price is fair, the market has a tendency, if this now is the new retail price, to go back and check. Is this really too high? Think of it like a shopper. You know, is this still too high? Or is this one now too low? And the market's job is to check. Well, we liked it up here. Is it now too expensive? And we almost tagged it yesterday. Are we going to come back and check it? I have no idea. But let's look a little further. Excess. Now, the market has been on a tear, right? Right? Up, up, up. Very nice. FOMC day. What's under FOMC day? Stops. What's under this low? Stops. Who's getting taken out? The longs. But here's where things got interesting for me. Yesterday, I was thinking, okay, back in, and we're going to wipe everybody out and get more stops. So here's what I use. Take a few notes, and this is my mental process. Just me. You do whatever works for you, but I think about the potential. So I know if I get under this low and there's stops, the potential is to keep going and we could really rip all these longs. I mean, is that logical? I'm just reading. If you have questions, post them. And I got to try to read them. So what do you guys think? What is this saying right here? It's if this, then that. If not, then what? If we come down and take these stops out, then the next target is here, and then the potential to cascade down, right? And maybe even get down here. 42.15. Not necessarily yesterday, but eventually, because this was the last retail price. So we have a retail price up here. We have the retail price down here. This is in a higher time frame. So if this, then that. If not, then what? We take out these stops, 42.57.75, and we get to 55. Huh. If this, then that. If not, then what? If not, back. Now what? We have shorts. We have shorts. We open today right in here. What that it's telling us is no change. Well, if we didn't go down, if this, then that. If not, then what? Then the sellers here and here, but especially here, yesterday's high, are vulnerable to being squeezed. So does that make sense? So who's on the hook? The sellers. Now, we don't know what is going to happen. So that part, we don't know. So we're all good with we know we don't know. Write that down if you haven't thought about it. This is not about knowing. This is a forensic approach to just looking at the participant behavior. Because if it doesn't do what the nature of the market is, which is if this was a high, and it might be, we may never get back above here, but if this is the high of this move, we can come back. We have that artifact at 4308 quarter. Write that down. That's called a naked volume point of control. And all it is, remember I'm talking about the auction, the naked volume point of control, or volume point of control, it's a term that just indicates where the high volume is in the developing daily profile. It's retail for the day. And this moves around during the day as the auction moves around. So you'll see it move, and we can glean some insight from that. But we have this artifact that was retail. In other words, in this day, FOMC day, this was the fair price, and it's that yellow line. We didn't get to it yesterday, which might, and this is very, very suspicious because obviously we may never get back there. The participants might have looked at this retail price and says, you know what, we're out of here. We don't need to check it. We only missed it by 2 points, 3 points, That's, in trading, horseshoes and hand grenades, that's close. So we may or may not take this high out. But remember, let's put the pieces back together. We opened in balance, which means no change. Yesterday, we took out the week longs and didn't follow through. See the evidence. Now, this morning, we opened with no change. In other words, and that sets up something called mean reversion. In other words, two-sided trade. No change. But who's on the hook? So we had early sellers, right? It was shorts in the morning. Then it turns around, has range extension up, which I'll show you, and then comes back in. That's a setup that we discuss in the Trader Lab. It's called the IB failure, which is a mean reversion trade outside in back to the VPOC, which I will show you. Once we check, that's a price check in the developing time frame, price check in aisle 3, too low. So what's next? North. And then we have statistics sitting out there. The overnight high, we had what's called the initial balance highs, all statistics that we'll talk about. And now these guys potentially, with their stops over the high of the day, are potentially on the hook. And that's going to be our objective today to see if we get there. So, any questions on the higher time frame context? How do we establish a trade plan? Well, we have to look at what's going on in the market behavior and then determine the potential. And nobody knows. So, it's not about knowing. It's a forensic approach, and it's about suspecting. Did anybody ever watch, what was it called? Can't remember. It'll come to me. I'm thinking of a detective show. But anyway, so let's look at the early. Are there questions? Post your questions about higher time frame, because remember, everything is built on higher time frames. How you interact with the market is going to be in the developing time frame, but you need to be always aware of where you are. So in relation to yesterday's RTH, in relation to the intermediate time frame, those composites that I was showing, where are we in relation to that? Where are we in relation to the ETH, which is the most recent auction? And then what are the statistics open and who's potentially offsides? It's kind of a top-down approach and then executing inside out. Are you guys tracking? Yeah, Columbo. Thanks, Ricky. It's Columbo. A very good detective if you guys have ever watched Columbo. It's back from the 70s or the 80s, somewhere in there. Rather simple, but logical. Trading doesn't have to be complicated. We think complexity gives us something over somebody else. Actually, simplicity gives you something over somebody else who is conflicted with complexity. So conflict is not good. Simple, good, in my opinion. Complexity is really, I think, a problem. So here's where we open. Now I want to show you the behavior. We open. This is the volume point of control right here. Let me try to zoom in a little bit for you here. Make it clearer. So this is our open. And so we opened, remember 70-ish, 77 is the balance area in the higher time frame consolidation. So this is nothing has changed. So the market opens basically, unchanged in the value. So it's opening. So what is possible? Well, it can do anything, of course. And you're going to go, Tom, you're brilliant. But yeah, however, let's look. RTH open. Market opens here. Chop, chop. no change from the previous day. So we're in acceptance. That sets up the potential for two-sided trade. So let's watch. Market opens. The volume point of control is here. Now at this point, I really don't know what's going on. I'm going, because I know it's two-sided. It could do anything. It breaks away from the volume point of control. The volume is migrating down, and the volume point of control shifts. This is my first indication that this is too high. So I mark it. I call it a variable high volume node. Now ignore this for now, because this is current. All right. So this is in the developing time frame. Now remember the context. The context is balance, potential, and acceptance. So that means two sides, probably retail traders, not the higher time frame, are potentially active. So I mark this, I call it a variable high volume node. And the reason I do this is because I don't want to lose where this thing is. Because this was an auction. This is too low, too high, too low, too high, right? Buyer and seller interaction. And in this buyer and seller interaction was the volume, and that's your retail price. Now the thing about it is, if this is too expensive, the participants can leave. It's like a store. You know, and it's just buyers and sellers. This could be your convenience store, you know, smaller volume. And then we break away. That is saying too expensive. Perhaps. It moves down. Now I'm going, okay, too high. Now let's look at the potential. It retraces. Where does it come back? Price check here. This becomes, if you have a structure for it, a potential short. Price check, rejection, break, pullback, short, back to here, back to here. That's mean reversion. So what is mean reversion? Balance, two-sided trade. And again, we don't know anything. Remember, nobody knows. In a trade, it's maybe. Except the auction. This is how market mechanics tend to work. What are the participants? You don't need an indicator to see what's happening right here. All you got to see is behavior, because this is how the market works. Break, pullback, short to back. Too high, where are we going to go? Let's go back and check here. There. Now what? Pull back to this. Now, this was too high. Pull back here. Let's just see what it does. Now, there's another element that I want to mention to you at 43. Let me just give you the exact number. Okay, you don't get to put all of these on this book map. 4364 is something called the value area low. And let me tell you what it is. Yesterday's volume, in spite of everything you saw yesterday, 70% of the volume basically took place between 4264 and 4281. Call it 82. That was what's called fair. Now, we don't know. What that's really saying is, for the day, most of the volume took place in that range, and then when we went outside of it, they were extreme. And the volume point of control yesterday, and again, retail for the entire day was around 42.77 ballpark. Look where we opened. You see? Where is the darn thing? It's buried under here. Hold on. I got to find this thing, because I want you to see how this works. 77. So if the fair price for the day was 77, we open here, RTH, see, that tells you nothing's changed. So that's why we anticipate two-sided trade. Is that logical? Well, Captain, that's fine. You know, what's your time frame? So the shorts were on the table because of two-sided trade. And remember, don't forget the higher time frame. We took out weak longs, which suggests the upside. The long side is ultimately going to win out in this. But in the meantime, these are potential opportunities that we discuss in the Trader Lab. Again, if you know, this is not what anyone else would do. This is what the Trader Lab does. And there's no judgment but what anyone does because we all follow our own trade plan. So I mark this here, and then I know where that 64 is. And it's a coincidence. By the way, if you think there's magic in here, no. It's always maybe. So this becomes the low of the day. And yesterday's low, we didn't take it out. So if you can't, and yesterday's low was an exhaustive low because once we took out the stops below the previous day, we came back in, and the fair price again was 77. You see? Logical. Now we have a stat, two stats again. The ETH high and low, or overnight high and low, has over a 90% probability one of them will get taken out during RTH. And the initial balance, high and low, one of them, initial balance being the first hour high or low, RTH will get taken out during the RTH session. And we don't know which one. So don't think anybody knows, right? However, the context suggests it's going to be the upside. But we don't know is what it will be. Except we have a plan that suggests, now it can do anything. You know, if we kept going down, that's all fine. But we didn't. So if this, then that. If not, then what? Same process as the higher time frame. We took out the week longs yesterday and we came back in. If this, then that. If not going down, then what? Then come back. Open and balance. If this, then that. If not, then what? We open and balance, then what? Mean reversion, outside in, two-sided trade. Nothing has changed. See? Now we look. Who's vulnerable? The shorts. Right? So early selling, mean reversion, puts the shorts in the market with the buy stops above. If this, then that. If not, then what? If we can't go down and take out yesterday's low, then what? Then the shorts in the market get squeezed. Then higher. Then statistics. Right? Are you guys tracking? This is, for me at least, how I think. It's a process. Because I don't know, because I'm operating in the I know, I don't know. But I have hints based on the participant behavior. And this is what market mechanics is about. It's not about anything more than tracking what the participants view. Now I'm going to show you another trade. And if you're in a two-sided trade, there's something that we call, it's still mean reversion. So let me try to find it for you. By the way, our target is up above. Just so you know. And again, the market could care less, all right? This is our target for today. And again, it doesn't have to happen today or ever. But that's an artifact of a retail price last time. Remember, Fed Day. Okay? So, and this, I don't believe, should be here. Nope. So that is our artifact. So that's kind of where we're looking, maybe. Again, nobody knows. So we don't worry about that. But let me show you this. This is a trade we discuss. I just have to get myself oriented here. That we discussed. And, you know, we do post these things in the Trader Lab, in the Bookmap Discord chat. And in fact, I posted this morning about 7:30 what the context was for today, which is basically what we're discussing right now. And of course, everybody does their own thing. This is just helping, you know, traders maybe get in alignment. Post questions if you have them. I want to show you the next trade that we discussed in the Trader Lab. And these are not trade recommendations. I don't call trades. What I try to do is discuss context. And then, is there a way to interact with that context? So the first hour high, let me just get this, is here. The initial balance, okay? And I think it was made here. So that high, that first hour then will be 9:30 Central Time. So at 9:30, the initial balance is fixed. So it's right here. Okay, right there. So that's the high. So now, remember, we hit this target down below. And again, no clue. But it's an area to observe, 64. We got there, you know, who knew? So I don't think I know. I don't know. I just know maybe. So here's the next trade. And I'm going to show you microstructure. And guys, if this interests you, you should be grabbing screenshots or go back in your own software and grab these, because these are structured based on the context. And one of the more difficult things for traders is to understand the context and get into alignment. It's not buy the mid, sell the mid, or any of that. Because if you're zigging and you're not aligned in the context, you're not going to have a pleasant experience, potentially. And again, every trade is random and you never know. But the fact is, if you understand context, you would not be getting involved in the middle. You'd be in the outside edges because of the context. Does everybody understand? And I think context is not an easy concept at all. It took me, I mean, I'm going to say my experience with it is I didn't even know it existed when I first started trading. Nobody ever talked about it. It didn't exist. So, remember, first hour's high up here. We take it out. Now we have another mean reversion trade. So why would the market be going up after? Because it was going down in the morning. It was outside in, mean reversion. You saw us on the short side. And also, you know what's above. Buy stops. Let's go back to yesterday. What happened yesterday? We took out week longs, no follow through. Who's on the hook? Shorts. What happens if we get early selling in the morning, which we had? More shorts, more buy stops. What does that do for us? It puts more fuel above us. So I'm aware of that, and the Trader Lab participants are aware of that. So now let's look at the next trade. And what is the next trade? If we go up and we take out that high, which was basically here, the early high. Let me just confirm that so I know I'm not, because these things get covered up. Let me just make sure. Not making it easy. Wait, let me look elsewhere. It's easier. 42.79.75. Yeah, so it's right there. Okay, so if the stops are above, so let's look. Now we're going to show you another mean reversion. Just keep tracking. Grab screenshots. Because what's the context? Two-sided trade. So what do we have in the market? We have shorts who are getting squeezed. Thank you for playing. The first hour high, right? Stops are above it. And if we exhaust out, what is the potential? Now the longs are on the hook because it's two-sided trade. Even though I know we can go higher. And I have, remember, statistics. Remember that? Right? Statistics. Here. One of them, overnight high or low, over 90% probability, remember? Initial balance high or low. One of them will get taken out. Over 90% probability. Past performance not necessarily indicative of future results. You got to vet, right? Your own stats. So I have this one taken out. I have this one still on the table. And so far we didn't get the one below. So I am suspecting eventually we might get here. So we might get here, take out the current high of the day. So anyway, in the meantime, we're looking at mean reversion. Now here's how it sets up. Is everybody with me so far? I'm trying to give you guys a sense of multiple time frames and trading inside out. Mandeep, I read the stops, and I'm going to show you how I do that with the stop iceberg detector. I find it really usable for me because I kind of think about retail trader behavior as a really good, call it a tell, In other words, what do they do? Where are they wrong? And I based it on me. What did I do? Where was I wrong? Well, I was always, I guess you could call me, except when I was a money manager, I was a retail trader, So early on, when I was learning, like all of us, I did the things I thought I should do. Buy the mid, do the VWAP, all that, right? But I didn't understand context. So I was, it was really easy just to be doing the wrong thing, and I never understood why. Well, now I understand. And I can still do the wrong thing. It's not the point. Trading is trading. But I have a better idea of what my opportunity might be. And now I have tools, and Bookmap is a tool that allows me to see inside. So let's look. Market comes up. We take out the initial balance high. Now, we have a setup, and this is not a trade recommendation, and past performance is not indicative of future results. I have to say that, by the way. that we may mean revert and come back inside. And the mean means, the mean is the high volume node, which is the VPOC in this sense. So let's look into here, microstructure. Now, when this happens, I am no idea. So you guys know there's no magic to pick the quote high. I'm still working on that, and I think it's one of those things that'll never happen because I really don't try to pick the high. What I try to do is look at behavior that might indicate the development of something. Now, here's how I do it. This is the session volume profile. This is just all the volume. Now, if you haven't seen these things before, you're probably thinking, well, what is it? But in reality, what's most important, at least in my personal opinion, is the interaction of the participants. In other words, buyers and sellers, right? Isn't that what makes up a market? A buyer and a seller meet and they transact. They agree on a price. So these buyers and sellers up in here actually had an agreement, and they did volume in here. However, once these guys transacted here, we fell away from it. That is saying potentially this and I don't know at the time, remember, this might be too high. Here's the other piece. As we're coming up and taking out the high, the first hour high, 534 stops. Now here I'm using the stop iceberg indicator. And specifically, the stops are most important to me because who do I trade against most of the time? Other retail traders. So this is them. 146 stops, still going higher. 28 less break. So what does that tell me? This was buy stops, no new buyers at this time, potential exhaustion because the buyers were buy stops, not initiators. They were getting taken out. Can you see how this might give you some insight? And again, it's not a mechanical process. We're really observing participant behavior. And up in here, if the buyers were buy stops and sellers were taking the other side of it, and then the buying stops, what might you anticipate? A counter rotation. Does that make sense? Yeah, Cyrus, I'm not going to go into the current context. The only way you understand the current context is to understand what happened and what it says so you can dance with it. But remember, the current context I've already reviewed in the higher time frame. So we're trading inside out. So even though we trade in this developing time frame, we have to put it in relationship to the higher time frame, which I already reviewed. And if you missed that, grab the link, the YouTube link, and save it, and you can review this if this is of interest to you up to sometime this evening before YouTube removes it. So you might want to do that, and I think that'll answer the question because I have limited time. So right here is potential exhaustion. We break. Right here, I'm going to show you now the structure. You see this too high at the high here, 82. Too low, right here. So this is your auction. Sellers, buyers, buyers. Where are the buyers? We broke. Right up here, too expensive. And I don't know at the time until I see this. Now we've taken out this structure. Here's what it looks like. You see that high volume node right there? This is an auction. Too low, too high. Think of the shopper. Too low means, yeah, it's on sale. Up here, I'm not paying that. And it's in a microstructure. This is the same process that's happening throughout the whole day, except it's right in here. So I'm slicing it. This is like those Russian dolls. I'm looking at the micro to try to detect these guys. This interaction. This is an auction inside an auction. That's what when I call fractal. And again, I don't know. But right here, this high volume, this is retail. This is where the most transactions took place in here, with this being too high. When you break away, it sets up the potential to come back in. So let's look at the behavior. Now we're going to watch. Back, this is the IB high, right? So right here, excess, if I want to get into this, for me, I can get into this here, or I can get into it here. This is the initial balance high. What happens at the initial balance high? Let me give you the rationale. It's mean reversion, by the way. Stops. One tick over this. So this is the initial balance high. This is right in here. This chop chop is an auction. There's a high volume node. Let me show it to you. Now this is, this, you may roll your eyes back in your head and think I'm going to pass out. But this is an auction. It was too high. Remember retail? We chop chop in here. It's an auction. Too high, too low. Microstructure, again, I don't know. Retail. So too high, break away from it. See? Now, this is the last auction, retail, and the initial balance high, the first hour high is here. What's above there? Stops. Are we going to come back? No clue. I have targets below, which are open. That's the mid, the VWAP, and the VPOC. Mean reversion is return to retail in the developing time frame. So this is micro time frame, retail, break, fuel below us. Now if we would have gotten down here, I would have nothing to do. Retracement, stops, only 11 at the initial balance high, right? Short, stop above here, target here. And this is a setup, not a recommendation. It is something we talk about all the time. And where's the targets? VWAP, mid, VPOC. Trade's done. Anybody have a question? This is mean reversion. Does everybody see it? So that is something we call the IB failure, or IBF. If you're interested in understanding it, I have about 60 PDFs available for download in the Bookmap Discord Traders Lab. You're all invited to take advantage of them, give you some ideas, help you understand context, help you understand the developing time frame, how you might dance with it. And these are really important. So it was shorts, 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 shorts. Understanding higher is on the agenda, right? So this trade's done. That's what's called mean reversion. And this is the mean right here, because the mean is the high volume. So if you think of this as a distribution of volume, which is what it really is, this is the fair price. Outside is unfair. Now remember what else is going on. In all of this, which is balance, shorts are accumulating in here. So we took the weak shorts out. That sets up the retracement. Now we're back here. Now for me, there's no long, because I want to take out. So taking these shorts out, getting back here, finishes that trade. Now since this is already done, I don't come back. It's kind of like, because this is a counter, call this a it's mean reversion, but it's counter trend. And what it's built on is the idea the market gets long, the market gets short. When the market's long, where are the stops? Retail trader behavior, mid VWAP. So if I'm going to take a short, who's on the hook? And my target, don't forget, we didn't get there. My targets are open and these stops are under here. So that's why short, boom, done. Now, it's not saying it can't go lower, but this is the primary objective. Is this logical if you understand mean reversion and if you understand the rotational nature of the market and if you understand where the stops are, which becomes the fuel? See? Any questions on mean reversion before we go on? So I did notice a trader taking the short after we hit the targets. For me, that's low probability because now who's on the other side? Buy stops. And let's go back. What else do we have? Well, we hit our target. Primary. Again, no way to know what is going to happen. Except, where's the fuel now? If we got the longs out and we didn't come back down and all we did was do a price check, and that's what this is, price check. And when we came up here, what was it? Price check. Same process, fractal. Price retracement, price check, stop pick, short. Down. Price check in a developing time frame. Same behavior, higher fractal. Logical. Where are the stops? Here and above the high of the day. Statistic, and I don't know where we went here because I'm not looking. Open. And a target above 43.08, right? So now, let's think of it logically. If the market got long and the stops are here, under, the mid and the VWAP and who knows, we took out the initial balance high, which has over a 90% probability, suggesting that the shorts were getting squeezed. And remember, yesterday, only weak longs taken out, which may or may not be material for today. Take out the weak longs, price check, and reject, then what? Potential to go higher. To where? Is it logical? If this, then that. If not, then what? Where are we? Oh. Does that make sense? Can you see how you kind of think it through? Any questions? And then we'll kind of get to real time. Humphrey, I don't know if it's the risk. The short at IB high. No, there's no risk-free trades. So we still have two-sided trade here. Now, I can tell you for me, if I don't get involved here, I'm perfectly okay. Just doesn't matter because I have this to be thinking about. So I know, now again, it can do anything. We could fall out the bottom end. And I want you to know that's possible because there's two sides playing in here today, right? I'm going to take this out of here. Now let's look at the auction up here. Now I can't pick a high of the day, right? I'm going, I don't know. Because my job isn't to do that. I don't know where it is. So, anybody who tells you pick the high and the low, I suggest you get in your Ferrari and drive in the other direction. And if you don't have a Ferrari, just save up for one. Then, so this here, chop, 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 this is a consolidation. You see it? This in here, and see, it happens in all ranges. I try to get into it in a very tight range because what's happening in all of this is happening right there. See? And it's happening here. So it's happening in all of this. But because it's chop, I don't know. Now, once it breaks out of this, then I can tell what's happening, but I can't execute in here. So it's not the point, Here you can see the high volume in here. So this rotation, this consolidation, too high, I'm not paying that. Oh, it's on sale. But now we're breaking out of it, which is saying at the moment, this high volume, which is retail, where we crisscross, is too high. So what's our potential? Come back. Check here again. And again, it's not a recommendation. So for me, if this is not my trade, it just doesn't matter. I need to wait for my trade. So I understand the behavior, but it doesn't mean I can do anything with it or I want to do anything with it. So where's the stops? Well, this is still mean reversion. See, we're back inside the initial balance. We fell out of this. Where's the stops? VWAP, mid, potential to come back here, and potential to come down to the other side. So we'll see what it does. But for me, I'm going to say is, and again, you have to have a trade plan. Is this your trade? Or is it park? Because you already took your trades and now you're waiting for your trade. Trading, at least for me, is not about trying to catch every squiggle in the market. It's about putting together the context and who's vulnerable. So we already took our mean reversion. We came out and took the shorts. Now we are mean reverting again. It's the same process, two-sided trade. Now, who's going to take control, take the ball? I can't tell you that. We're still in a mean reversion because we're in balance. So both sides are on the hook here, you know. So, and so for me, tourist. But we can see the structures, right? Does everybody see the structures? Do you have a trade plan to trade here? I have to tell you, I have an overnight statistic here that's over 90%. So who was it? Dirty Harry said, do you feel lucky? So I may not be on a short here. Unless my trade plan doesn't care about this statistic. Let me look here a little further. And this is where order flow can give you a little heads up too. But order flow is pretty flaky. You know, in other words, it doesn't have to be real. Like right here. See, this is in the book. Market comes up, takes it, hits it, pulls back, checks it. They come back in over here. Let's see what happens. Now, I don't consider these actionable, but if you start, in other words, based on what I do in the Trader Lab, I kind of stay away from this. We have webinars specifically on order flow. So I'm trying to really focus on market mechanics and understanding a context. Then you can always add in tools, you know, like this. This is a potential selling event based on the order flow and the alignment. However, picking the high a day, not so much. Here you see microstructure high volume node. Right in here. We break below, we pull back. You have support here in the book. It's a short potentially if it's part of your trade plan. Again, I don't discuss these. I guess I am discussing it, but I don't discuss them because if you don't have the basic understanding, it's not about trying to find trades. It's about being sure that you have a handle on interpreting context, and then you have a trade plan for that context. If you're in the wrong context and you're trading a plan that's for a different behavior, you're not going to have a good experience because you're out of alignment. So right here, the book supported the short, and the microstructure right there is your retail price in this interaction up here. You fall out of it, and where do you come back? Look at the alignment. So alignment for a short, and I normally don't go into this because I don't want to make trouble with this and the auction. Remember, auction, test, break, short. So short here, stop over here, not a recommendation, break, pullback, volume, here, structure, so other opportunities. So chop, chop, break, short, chop, chop, break, short, mean reversion, stops, VWAP, where potentially back here and lower or not. Does that make sense? And I don't want to make trouble. I'm just trying to show you structure. Well, Mason, the thing with statistics is, the thing is that they're out there. But it's for me, it's a prioritization, and this is hard because it creates conflict. In other words, getting short here with that statistic right above, I know that's open, but I know what's the current input. See, think about it as a prioritization of inputs. So we have yesterday's RTH, right? And the previous, so we have the higher time frame intermediate context. We know the longs got popped, but weekly, so there's still longs in the market. We know there's shorts in the market too from yesterday and the day before. So who's vulnerable? Well, both sides are vulnerable, but it seems to me that the shorts might be more vulnerable, but I don't know. So the developing time frame, even though we have the statistic open and we have another statistic above us at 4308-ish, are open, which gives me the leaning towards the upside. I know we're in balance. Remember, nothing has changed. That 77 is balance. So it's two-sided. And again, I don't know. We could come out the IB low, no problem, and get down here and take this one out. That's what we don't know. And the reason is balance. Now, there's another thing to be aware of in balance. We can take out the IB high and the IB low. And the reason is balance. So we could take out the shorts, which we did. We can come back in and mean revert, which would take you back here. And now the longs have their stops under here. They can get taken out. And then we can come back in and just slosh both sides, abusing everybody. Well, that's tradable if you understand the context and you have a plan for it, And you understand that one of these stats has over a 90% probability of getting taken out. But let's think through it again. We're taking both sides, right? We took this out. So we can come down, but we already did this. So let's look at what we've done. See, you got to kind of look over here. What do we do? Well, we mean reverted, got here, boom, took out the shorts. Fine. Who's in the market right now? The longs. And if it's truly balanced, nothing says we're not going to come under here because there's fuel here. And where's the rest of it? Under here. So it's possible. So if you're doing mean reversion, which would be from up here, if that was your trade, and if it's not, it's not, this is where you're going. Then it's helmet, just like it was over here. It's helmet time, because we could have done this move from this. Well, we didn't. So then the shorts had a cover. Thanks for playing. Now what? Exhaustion, mean reversion, back. Except now, where's the stops? Below us. So we got to see. But this is the target, in here. Not a recommendation. But it's logical, isn't it? Mean reversion. This is the mean. Stops here, under here. So potentially, if it was me, obviously I got to think about this, but I'm also going to think about this. Any questions on the logic? Humphrey, I just share market mechanics. So I don't, the Traders Lab is really giving traders tools and then have them develop things. I do offer, all those PDFs that, traders can look at and then think about it, what's going on. And it's really a narrative. That's kind of, at least in my mind, it's process and narrative. And it's always maybe. Maybe it'll do this, maybe it'll do that. If it does this, then that. If it doesn't do it, then what? So like here, if it doesn't do something, like continue down and take these guys out, then what? Well, then short covering. And again, I have no idea, So that trade's over. But once we come out here and I see the auction, I know then we can get, stops are going to be under the IB high, right? Retail trader behavior. Stops are under the VWAP and potentially mean reversion. So this. Then longs. So now this low, current low, is more vulnerable. Market doesn't have to get there, but what's the condition of the market? Two-sided trade. Right now the shorts are taken out. Who's left? The longs. And again, it never has to do any of this. It could just come down here. I don't know where the mid is. Somewhere. It's probably in here. So it could come down, take the stops at the VWAP. The mid, I would assume, is around here someplace, or was. Where is it? Got to look. Oh, it's above us. Yeah. So 77 quarter-ish right at the open, and then potential back here. So that's kind of what's on, or not. Remember, I don't know. Look at this. This is skewing the book. Is that real, or are they just pushing it up? I want you to see, when you see liquidity, what is the purpose of this? Is it just to get retail traders in? Is it to skew the book so they can be selling? What is it? I don't know the answer, by the way. But if I see liquidity, it's not actionable. So I don't base a trade off of this. I base a trade off of the auction. And that's that prioritization of inputs, you know. Now, let's say you were long. Let's go back here. You're long, and this is your target. Doesn't get there. There's no way to know, right? So you got to have a trade management process. Or how about this? I'm just giving you some ideas. We think it's going here, which is what I would be thinking, because that is the next target based on the statistics. Right? One of them. We don't know. But I think it'd be reasonable to say it would be this one. Yeah. But I see the auction. And I see the auction and I see it break away from the volume, which is telling me counter rotation. Now, I don't know. It's just a trade. Right here, it fails. Do I exit? Or what do I do? Or do I see the exhaustion and know now that we can mean revert? So what's your trade plan on that? See, you don't have to be short here, obviously, but you could be out of a long and then be looking, to re-engage subject to your trade plan. And if you don't have a trade plan for this condition, guess what? Your job is not to trade. It's not to make trades happen. Your job is to wait for your trade based on your process and your understanding of the context. When those are not aligned, your job is just to sit and be a tourist. You're not here to make up trades. You're really here to understand the condition, and when it aligns with your trade plan, to take advantage of it. Hold on one second, guys. Any questions? Yeah, okay. Sorry, guys. Any questions? I got distracted here. I'm back. Yeah, Humphrey. I don't. There's no cost. I don't. There's no cost for this. There's no subscription. I'm not a vendor. I'm not into that at all. This is just I'm sharing some pieces of what I've developed and how I've evolved with over 40 years of trading. So, and I will tell you that has not always been a pleasant experience, because that's the nature of this process, of developing, I should say, a market understanding. And so no. If you're interested in, being part of the community, it's called the Trader Lab. You would go to bookmap.com, join the Discord chat. You don't have to be a subscriber. You won't be solicited. And there's a lot of education, not just what I do, but stocks, options, crypto, other financial products. So it's pretty diverse. And order flow. And order flow in and of itself is its own animal, because remember, they're in a different time frame than us. HFT, algorithmic behavior, is really a whole different animal. So it's kind of, where are we in the financial food chain? We're not in a good place. We're kind of at the end of the bottom of the barrel. So I think if we know what the statistics are for retail traders, that we have to understand why that happens, or it happens to retail traders, and then not do what they do, and understand what they do, why they do it, and really just have a different approach, because that approach doesn't work for the majority, and I mean over 90% according to the statistics that I'm aware of anyway, of retail traders' success. So if that is the reality, I can use that behavior that is consistent, make it an asset, and also, if I can understand the interaction of the market, why? See, most of us are using indicators, which don't teach us anything about the market. We're constantly trying to get the indicator to do the work. And then we're going to tune them and tweak them, and we're going to be looking in the rear view mirror, optimizing, which is just more chaos and randomness. So that's why I don't use any indicators, only because I don't need them. I need this real-time input. I don't want something that's looking backwards to tell me the market's going down. I can see it right here. So I'm just saying is that's my approach. And then when it comes to the higher time frame, which somebody, by the way, this is our target, right? And potentially the low of the day. So we'll see. I don't know. Not a recommendation, right? We're just tourists here. Remember, I don't give trade recommendations. This is how I look at the higher time frame. In all it is, it's very simple. None of this is complicated. It's all logical. It looks complicated until you understand what it is. If you think of the market as an auction, you know, too low, too high, where's the sellers? I'm not paying that. Where's the buyers? Oh, it's on sale. See? This was 42.15. It's a retail price from a consolidation. What I do is I look at where the market trades over itself. This is the beginning of what's called balance. Too high. In other words, I'm not paying that. Well, where's too low? I don't know, by the way, but I anticipate this. Well, the thing is, here's so I overlap these. I draw a profile over this because I want to see in this auction, where is the volume? Where's the retail between this time frame participants? It's right around 42.78-ish, right in here. So if that's the case, that's fair. Too low, too high. Fair. We open in fair today. So that's why you're getting two-sided trade. Now let's take it one step further. And this is where being like Columbo, a detective, right? Yesterday, so if this is too high, yesterday we were short, 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 and then we had a squeeze. We came all the way up, got to 43.05. We have an open target at 43.08 quarter. We missed it. Again, that might be too high. That's a retail price from this day, FOMC day. And here's what else we did. We took out the sell stops here, and we took out the sell stops here. And the key to this is it's a tell. Right here was the low of this day was 57.75. We're selling off. We only got to 55. Why didn't we just keep going? If the week longs are getting taken out, right? Why did we come back in? Question. Does that mean that we only took out week longs and that potentially we're going to eventually come back up and take out this high and squeeze a little bit before we either go down or continue higher? And I, don't have an opinion about that. I'm more interested in this. So we are trading right now this with the shorts vulnerable. And again, no idea. If we break out of here, then down. You see? So the reason that we're going with this mean reversion is nothing has changed. Because the market participants are saying, yeah, we like this. Now we can come out and we can come back. We could do anything, right? So in here, until it changes, for me, it's mean reversion. I hope that answers the question about the higher time frame. And I went back to it because if you don't put these pieces together, it's about trading inside out. So now, if I'm thinking balance and two-sided trade, I have to go back to my developing time frame and go, okay, what's the story here? Well, I got statistics. I know if the shorts got shot over here, auction, too high, where am I headed? Back here. Can you see it? Then who's on the hook? Let's go the other way. It's logical, isn't it? These guys. If you are long, tell me what your emotional state is. Where's your stop? Might you have it under low of the day? What statistic do we have available? The overnight low. And we can take out the overnight low, take out yesterday's low, come back in, or not do any of this. We could just come under here or not. Again, I have no idea. This, I don't know. So I go in I know I don't know. But what I know is the context. So until it changes, which it will, and it changes in a day, I'm inside out, outside in, no inside. So if it comes here and it takes off like a bullet, great. But why would I think it won't do that? Because of this swing in the low of the day. and my statistic. And I'm going, I don't know. So I don't know. And the fact that I don't know doesn't matter, because in trading I know I never know. So I don't think about knowing. I think about possibilities. And I know that if I don't get this statistic, that everybody who's long and has their stops under here and their stops under the low of the day, that now they're on the hook. So let's watch and see. Is this logical? Humphrey, I don't use any indicators, so I don't know what to tell you on that. I don't know, you know. Um, but this is mean reversion, guys. This is um, something that I think contextually you really need to stop and think about. I recommend you go to the Trader Lab if you're interested in getting pictures, if you will, of these circles, arrows, diagrams, balloons, you know, all those things, where I detail out these behaviors. And it's not that, and this is not, remember, I'm not a formal educator. It's not what I do. I'm not a vendor. I have nothing to do with that. No interest in that. Um, my interest is trying to help traders get the foundation of a understanding of market mechanics and behavior. Because if you don't know why, you're always going to be confused, I think. And we're all confused a lot of the time. So don't think this doesn't eliminate confusion. What it does is it helps you stay in alignment. And then if you have tools, you know, like in a mean reversion trade, maybe uh, divergence is workable here, you know. But where do you get short? Would it be on this rotation? Would it be on this one? Would it be, see, how do you know? Would you be selling, selling, selling? Because divergence has no clue. So if you have something that you can read the auction, maybe that divergence will happen when you have structure. And I have no idea. I haven't used indicators in so many years I don't remember. All I know is it wasn't a good solution for me. And I built trading systems. So they were very math heavy, mathematically, math function heavy, with optimization structures and arrays in them. So they were, you know, kind of happening. And I traded with them. Here's the other problem. I traded with them. But I was always kind of, you know, looking backwards to try to get forward. And you're always trying to, you know, it's like driving in the Indy 500 looking in the rearview mirror. It's not a good plan, ultimately. Though at times, certain market conditions would be in alignment. But the market doesn't stay in the same condition. It changes during the day, and, you know, all of that. So that's very hard to have a systematic approach that is somewhat rigid to certain contexts. That's my point. So in the Trader Lab, we talk about context and different trade plans for different contexts. This kind of day is not the same day as where you buy the mid and off you go like a rocket. If anything, this is where you avoid the middle and you're on the outside edges. It's completely different. That's the difference, I think. So rare, did I answer the question? The time frame for the higher time frame is where there's balance or overlap. As soon as it goes into a consolidation, I combine the volume of the daily RTH candles. Until if it's trending, there's no balance, which means no consolidation. There's nothing to combine. It's when it falls back over itself that then it's starting to potentially change. You know, does that answer that question? Oh, eighth trader, I don't use any indicators. I don't need a VIX to tell me the market's rotating down, and so the VIX is ticking up. I don't need to look at any of that. I used to. I used to have 32 markets up. How do you like to be looking at all that stuff? You know, I'd be watching the dollar. I'd be watching the dollar yen. I'd be watching the bonds. I have the VIX, the trend, the you know, ratio of up to down volume. You know, issues, blah blah. Yeah, I don't look at any of that because it's not material. What's material is the interaction of these participants, and what they perceive as fair and unfair, and then that behavior gives me an indication of, you know, what might happen. And then it's where are we within the previous day's area. And remember, 77 is sort of the fair price, you know. Um, so if that's the fair price, until things change, the market kind of likes this. That's why it's mean reversion. And that's why the stops, I think they were over here, are vulnerable. But the primary target in mean reversion is the mean. And now we're adding one more piece in, a statistic, and one of these, the overnight high or low, is on the hook. Longs in the market, they've had their play. So maybe we take them out and then come back in. All things are possible. But until it changes, this is what it is. It's kind of if this, then that. If not, then what? If we don't get to this stat, then what? Well, the longs are vulnerable. Mean reversion. Price check up here. Failure. Where to? Here. And in the trader lab, one of the things we talk about, or I mentioned to them, is traders who are trying to kind of create setups, right? We all want a setup. Well, the setup is only appropriate if you understand the context. If you understand the context, and so you guys understand this, what you're seeing here is most of the time what the context is. It's mean reversion, it's rotation. That's called balance. When it gets out of balance, you get a trend configuration. That's, in other words, it runs away and it doesn't know what it's worth. It goes, I don't know. And it goes. So lots of times it's a squeeze, and we're one side, like when you break out of a consolidation, you get these higher, these bigger ranges because of all the energy. You look at this here. This was a consolidation. We broke out of it. See the run? See the run? See the run? See the run? Now what? We're coming back on ourselves. So that is forming a consolidation. Now, I don't know what it's going to do here. Remember, we can come down. This is a suspect because we didn't get any further yesterday. We can still come out. We could do anything. So remember, that part I don't know. What I know is what happened yesterday and where we opened today. That's what sets up two-sided trade. One side is going to blink. I know these guys are short. We have shorts. This has a potential to squeeze because of what we did yesterday. See how I'm putting these pieces together? Other than that, I don't know. And it's not, I can't know. What I know is the possibilities. So I'm on guard. I have a statistic. I have the overnight high. I have the overnight low. I've taken out shorts in our developing time frame, and longs are vulnerable. I can come down, check this low, come back in, check the low, keep going, or never get there and just rotate. I have no idea. So that's what I know until it changes. So that's how I think of it. I think of context, and I don't know when it'll change. I just don't know. But I know, and the reason I was mentioning mean reversion to you guys is most of the time the market's in this situation. So most of the time it's going to be rotational. Once it's in an area it likes, it's shoppers. I'm not paying this. Oh, it's on sale wherever that is, or it's not, and back. If it changes, and what you need to understand is the market goes through interday, it changes its configuration. So we might be directional in the morning and then go into balance and start rotating. So all of a sudden you're not trading it the same way. If you are, what works in the morning, and if you find that it starts out one way and you're doing all right, and then something happens and the same things you were doing earlier are now getting you jammed, and you're giving back your potential gains from the morning, if you don't get a sense of why, then you're going to keep doing that. If you can get a handle on context, and nobody knows what it will do, so don't think that's going to happen. But if you can recognize behaviors, you might be able to either adjust your game plan or stay out of the market because it doesn't align. I mean, there's three positions in the market: long, short, flat. Flat's pretty important if that's where you lose your dollars and give back your gains from your hard work and risk from earlier on when you were in alignment. At least that's my feeling about it. So I'm not trying to figure out how to trade every wiggle. I want to figure out when to trade and then when not to trade. It's like waiting for your bus. Notice how we got below here and took these stops, right? That was pretty logical. Now what? I don't know. What about these guys? Are they on the hook? Don't know. Is this statistic going to go, or are we going to come all the way back up and take this one? One of them over 90% probability, and I can't tell you which one, so I'm just outside in, right? Mean reversion. So what is the process that might be most beneficial? Not easy, because nothing is, but it's simple, is learning mean reversion and having a plan for mean reversion, because this is the condition of the market most of the time. Rotational, right? It could be directional and then get rotational, and you're still going to trade a rotation. If you guys watch my videos on trend day configurations, there's a lot of similarity, because even if the market is directional, let's just say we were up, 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 and this thing never came back. Well, it still rotates, and if you can detect the trend, you're going to use counter rotations or mean reversion to attempt to get aligned for a continuation. This process has multiple uses. It's either outside in, or if we were going up, 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 you'd be using the counter rotations for continuations up, subject to context. That's why mean reversion, I think, is kind of a basic concept that you can use in a lot of different scenarios. Any questions, guys? Is this making sense? Well, the VHVN is stale. Not using it. It's mean reversion. All that is done. We are in balance. So it's this. Outside in, who's vulnerable? That's the way I think about it. What statistics are open? Low, overnight low and high. That's all I know. What happens, and for me, the primary trade is to here, and maybe a little stop pick because of this swing. And after that, it doesn't matter to me. Now, if I'm trading, and let's just assume I'm not going for this, which, and in the Trader Lab, we only talk about 2 contracts, not multiple, not runners and the rest of it, because I want to keep it simple. Because if you can build a trade plan, in my opinion, on a 2-contract process. The job of the first contract, and this is not a recommendation, it's just something we talk about, and that's subject to, everybody's different. But 2 lots, the first lot is to get you risk neutral. In other words, buy your stop. And your stop is from entry, wherever that is, to where the trade fails. And for me, it's structure. I don't use like, oh, I'm going to use a 5-point stop. Why would if the trade fails at 3? So, from entry to failure. Then my goal is to get a rotation to cover the stop. In other words, the distance from entry to failure. Now I'm risk neutral. Now I just put my feet up, put my helmet on, and look for my target. And then be done with it. But what's wrong with this trade? It's about a 3-point risk, right? Right? 3 and change to here per contract. So you got 6 points. You get 3, risk neutral to here. Does anybody have a problem with that? Is that not cost effective from a risk reward standpoint based on the context? Just a question. Well, Kendall, I don't think you have been here long enough to make any judgment. How long you been watching this stream? I mean, if it's not for you, you shouldn't waste your time, obviously. But I don't think, unless you've been, this is a process of trading in alignment with auction structure. The candles are not part of this other than the daily time frame. And even then, it's not about the candle, it's about the volume. So the candles are just representations. They could be bars. It doesn't matter, And of course, a wick on a candle does give you information, right? But I see the same thing in the volume. So the difference is with a candle, I need to see the volume that transacts because that's the true auction. It's not price. in my opinion. Again, this is just a process. It's what transacts and understanding why the market does what it does. It's not about a high and a low. It's what created it, who creates it, and what information might you extract from that that is actually usable to potentially engage with the market at certain locations that are part of a trade plan. So, if this is new, hang out. And if but I always say at the beginning of the stream that if you haven't viewed the market this way, it's going to be very foreign. Only the reason I'm saying that, it was to me, you know. And when I first saw it, I thought I'd landed on Mars, and I said, "This is crazy," because I grew up on charts, and then indicators. So over time, though, I found the limitations in all of those, and everything has a limitation. This does too, but this keeps me closer to the actual real-time development. So, because I'm trading inside of all of this, so this is my kind of like my lily pad, and I'm trading a context called mean reversion. So it's outside in, and the longs are vulnerable. That's all I know here. After that, I don't know, but I'm in alignment. And the behavior of the participants is really what trading is all about, in my opinion. And if I can detect that behavior in the shortest time frame possible, it allows me to interact with the market and cut my risk down to the smallest increment that I can, and hopefully, with my plan, get risk neutral and then go on to target, which primarily is here, and the bonus round would be under here. But the trade can be done right here. And that's, I think, pretty good, Again, that's just me. It might not suit anybody else because my time frame is I'm attempting to align in the developing time frame, overlaying it inside of higher time frames. So anyway, I hope that makes some sense, Well, oh, little, um, it can do anything. But here's what I know. I know that I have a statistic that either the overnight high or low, which is here and here, over 90% probability one of them will get taken out during RTH. Again, it's not 100%, so maybe none of them get taken out. But I know who's on the hook now is the longs, and I know it's a two-sided trade, and it's mean reversion, so it's outside in. We've been squeezing up here. We didn't get to this statistic, and it's almost like logic in the sense of being a detective. It's a forensic thought process. Well, who's vulnerable? Well, we have sell stops under here. I don't know if we're going to get there. No idea. And we have a statistic here, which we may or may not get to. If we get under yesterday's low and there's more selling and we don't just come back inside, then we can extend. So it can go off either side. I can't tell because it's two-sided. So one side may throw the towel in, and I'm prepared for either one. It just doesn't matter. And if we come out of this range, it sets up then a directional move. I'm inclined to think it'll be to the upside, but we came pretty close to hitting an upside target yesterday. So it's very muddy for me because we're in balance. So I can only at the moment work outside in because it's mean reversion. That's what balance is, two-sided trade. That's all it is. So the median, which is the mean, I should say, the mean is this, because that's where the retail price is. This is where acceptance is. So if we get outside, think of it like a rubber band. It's stretched out, and the buyers go, it's too high. So where's it going to come back? Potentially to retail. And then it has the potential to come out the other side and go, where's too low? And not forgetting, and I don't mean to keep repeating, there's stops under here. So that's part of my logic. And then again, with any trade, we don't know how, if, or when. See, the thing with the trade is the rotational aspect of it is random. So we don't know, like here. I think we had the short here, right? To here. Why did it stop there and make new highs? Why didn't it go down and take out the longs over here? I have to tell you, I have no clue. So we come back out. Auction too high. Where do we come back? Back here. What do? Take out the stops under here. Very logical. Now what do we do? Don't know. So, but I can't initiate in here. I can only work on the outside edge because of the context of the market. And then possibly this is still on the table, so I have nothing to do. If I'm running a two lot, and that's all I talk about in the Trader Lab because we're thinking build a foundation, right? I'm done here. If I'm running threes, so it's scale, target, hold. That's the next trade because I have a statistic and I have longs vulnerable under here. Does that make sense? So that's kind of the rationale. And again, nobody knows. But the primary thing is back here because that's what mean reversion is. Any questions on mean reversion? It's a good day to see it. David, as far as the spoofing goes, no, only after the fact. David, when it comes to spoofing, I am a big suspect of order flow, but I do know the difference, and it takes a lot of time to see the nuance of the book, and that's because there's different participants with different agendas. You got algos, you got HFT in there. It's different, you know. So, you know, icebergs and all this, it's all different behavior. So I find that I prioritize my inputs. In other words, for me, the most meaningful information is the participant behavior. That's where the rubber meets the road. What do these participants think in here? I can see it. Why does this exist? Well, I can see it. If this is too high, in other words, this auction, this consolidation is too high, and this is the check, and it breaks away, then what? Next time, developing time frame, back here. It's logical. Then what? Potentially, and it's only potential, down here, and maybe here, and I mean, don't know. So that's why if I was running three, I'd be going to this. But the trade primarily is done over here. And then this is sort of your icing on the cake part, you know, like a runner. And if it comes back up, you know, then you have trade management for the runner. You know, so that's up to your trade plan again. That's why with twos, this is still a very nice trade, I think. And it's all very logical and it's very structured. So I talk about structured trades because you can kind of wait for them. You know, it's like stalking your trade, and it's about alignment with the context. And I think I've already discovered it. Discuss that. By the way, guys, if you're interested in reviewing this, because if you haven't seen this type of process before, it's going to be very different. And it will also conflict with your beliefs because it's another way to, let's just say, read the behavior or understand market mechanics, which is what this is about. This is not about indicators because I don't need an indicator. I got the real-time interaction of the participants, which to me is the best indicator. What do they think? Not what my oscillator thinks or my moving average or my pencil line that I draw on a chart. The market doesn't care about any of that. What the market is all about is the interaction of the buyer and the seller, right? That's really what it is. And the other part of the market is trying to find a price that these participants might agree on that's fair. Right now, this is their price that they think is fair. So currently, it's too expensive out here, and then we got to see, is this still too low and we're going to take these guys out, or are we going to take these guys out? That part I don't know. So that's, you know, but I have pieces that I do know until it changes. That's pretty good, I think. After that, I don't know. Then it's trade management because of randomness. See? So that's as far as I can take it because that's all I know. And then it's like everybody else here. I'm waiting to see what the participants decide because I don't decide. I just try to get aligned. And then I take my risk and either, you know, trade works or I take a stop and I go on to the next trade. But for me, the trades have to have risk-reward ratio too. When I'm up here, this is my target that pays, right? If I'm up here and I take a 3-point hit, or on a 2-lot, 6 points, it still was worth it because of the risk reward. If I'm sitting and I have no range, I have no trade. Doesn't matter if I know the context, doesn't matter what I see. If I can't make it worthwhile based on my trade plan, then I'm just sitting here and I'm watching because I have nothing to do. Any final questions? And David, I hope I answered your question.
And oh, little, as far as understanding the auction, it takes time to think in that way. It just takes time. And if you're interested in any of this, there's come to if you're interested in the Trader Lab and the resources, I have 60 PDFs I've posted of different configurations that you can review and in your spare time and away from the market, and just look at them and look at what it says, because this market speaks. It actually is giving you a lot of information. It's a way of interpreting it and not depending on some plug and play indicator to tell you what's right in front of you. Because an indicator is pretty generic. And if indicators actually worked over the long haul, I don't know why they have 80 or 100 indicators in a software package. I've always thought, wouldn't they just have the good ones in there? And but why is that? It's just something to sell software, in my opinion. And the other fallacy with the indicators is they work at times. What the indicators are not sensitive to is context. So when we use indicators, we're tending to always do the same thing with them, even though the condition of the market's not the same. And that's where I think the problem is with an indicator. If you can understand the context, you might better deploy indicators, because you know when they will work for a specific condition, and you also know when you shouldn't use them. I think that would be an important contribution to traders who want to use those tools. Um, I find that too many inputs create conflict and inconsistency. So I've kind of gone the other direction. And a lot of other traders I know, I'm just going to say traders I know who have been trading for a while, use this process. And indicators are really not a big part of their toolbox, for the reasons I've already stated. Doesn't mean it can't be part of yours. I don't make a judgment. But I am showing you something here that I think can contribute to your understanding. And then it's how do you deploy whatever tools you want to use and minimize the conflict. Because if you have conflict, you're going to be that it's the conflict stimulates the in the mind the fight or flight and the fear and all these things. And there is no certainty in trading, but can your process have a certain sense of certainty and consistency? If your process is consistent, you can measure it. If you have an inconsistent process, then you've got chaos, in my opinion. If you're interested in those PDFs, I invite you all to the Trader Lab. Go to bookmap.com. It says join Discord, and also take advantage of all the other free education, stocks, crypto, order flow. I mean, there's courses on order flow. You don't need to be a subscriber. You won't be solicited. And as far as Bookmap goes, if you find a way to incorporate it into your process and you see let's just say, gives you a net profit off of the cost, like everything, cost of production. If it gives you a yield, then great. If not, then don't bother. You know, I think you can trade effectively, but I find that because when I started using this tool, and I got it in 2015 when it first came out, before all these enhancements to it, that it allowed me to reduce my risk because I could see better inside. Um, Versus using Renkos or any ticks or any price-based bar. So um, I could see better. So it reduced my risk for me. So tighter stops, and if I have a better entry, then my distance to get risk neutral is closer, right? So it skewed everything in a positive way. So that's at least my view of it. So and everybody, not everything's for everybody. It certainly isn't. But most retail traders never are in the business long enough to get to use a tool like this. And like every tool, if you're looking for an indicator that's push, and whatever you call it, click play deal, plug and play. This is not. This has more sophistication. It's more advanced. So, by the way, where do we just go here? 582 stops. Let me just take a look. Just want to be sure what's going on here. Initial balance high. Came down and checked. So this is, remember, I'm thinking the longs are vulnerable, but I don't know. See, I can't tell. What I know is mean reversion. Let's look at what we did. We came down and checked, and This is too low. Outside in. But since we came down here, I'm not going to be on the outside in, even if it comes back here again, which is the possibility because we're still in balance and mean reversion. Who's on the hook? Remember, I'm still thinking a short squeeze, and I can't tell. So I'm just telling you, this is the straight oil from the can. I don't know. So this is rotation. That's what's, so if we went here and now we checked here, see, this is retail, right? Look, this moves higher. It's suggesting at the moment this is too low. This is the same process up here, except microstructure. The volume in there was too high. We came back to the volume in here, potentially, and I don't know, too low. The volume point of control, which is the developing volume for the day, moves higher. This area here was too low. We check it, too low. We rotate up. Potential now, mean reversion, but only to here, and potentially here. Nothing to do. I am in park because one of these sides is going to get taken out, and I couldn't tell you, so I don't need to do anything. But look at my range now. So I have two possibilities. This is still mean reversion. Back here, still break below or break high, and I don't know. So I can just sit here now and do nothing. I have no need to trade. Just me. So what's your trade plan for this? Do you keep trading it? Or do you look at where the fuel is and what the market has done and what it hasn't done? If this, then that. If not, then what? If we don't get down and take the longs out at this time, then what? If this moves up and we test it from above, which says this might be too low, then what? If we come back and take out the stops at the IB high, which I think we did, then what? Counter rotation back in, or too low and then squeeze. We can hang out a little bit if you're interested, and we can kind of see how it develops. But, it's lunch in Chicago, so chop is not unusual, and this is balance. So that's our context. I don't know what it'll do. But for me, if I'm going to take risk, I want it to be with range. Once I get to this, my risk doesn't change, but my opportunity goes down. So do I want to trade in this? Well, I know that the opportunity would be to here, and then I don't know. So the range is compressing. Does it make sense? Now, I can't enter here. I'm still looking to try to figure out how to do that. I can't. Let's look at the microstructure. See this little rotation right here? You see that little high volume node? This is an auction. 500 stops coming up. 21 exhaustion. Right here is high volume. This is your micro retail price. This is like your convenience store down the street. Location, chop, exhaustion, don't know at the time, break, that's a trigger, pull back to the microstructure. Now this is not a trade I would take because where am I going? Short, so let's assume, you're in 78, and I'm saying, because it's not anything we do, stop above 80, 2-point risk, target. 5 points. I don't know. Do you want to risk, what did I say, 2 for 5? And it's really 4 because it's 2 lot? Or you're scalping a 1 lot, but, to here? I don't know. What's your trade plan? And then we're back into this thing again. Or not. This is a mean reversion. The market's condition is outside in. So I have no idea. But, I don't know if it's worth the trouble. What's your trade plan? Any questions on mean reversion, since that's what we got? Orion, my stop is based on structure, and I can typically get around 3 point stop in the mini, which is $150 a contract. Um, Ballpark, 3.5. This one was less. It was like two and change. I like that because my goal is risk management first and minimum risk. And because look where my target is. I mean, I don't have a lot to work with here. you know 4 point, 3 point. I mean, I could get risk neutral, but I know, let's go back to what we know. Too low. Volume and price are migrating. It puts these guys potentially on the hook. And I don't know, but remember, we are suspicious of a continuing squeeze in this statistic. I can't tell which side is going to win, except what we did in the higher time frame yesterday. Let's go back to that. See, this is kind of how I try to put pieces together. And I can't tell what it'll do. Nobody knows what it'll do. If somebody does know, I want you to reach out to me personally and we'll have a nice conversation. But other than that, I can only try to stay in alignment with it and accept that it can do anything. This is the tip-off to me of to be very careful on the short side, because FOMC reversal yesterday, take out these longs, thank you, take these guys, but come back. And here's your body, or your volume. Here's in this consolidation which is developing, 78, 77 is the fair price in this volume. So, and we're accepting it. So who's on the hook? Well, longs down here. Why didn't they get taken out yesterday? Question. Bing, bing, bing. Question. Question. If they didn't get taken out and we had profit taking, shorts, and weak longs out with no follow through, that puts me on alert of potential squeeze and potential takeout yesterday's high and then fail, or whatever it does, or continue, wherever. I don't know. But this is indicating to me that I have to be a cautious short. And so far the market is suggesting squeezeteria. And I have a target at 43.0825. Not a recommendation. Is everybody tracking? Any questions before I sign off? Got a bunch of comedians over in the Trader Lab. By the way, you guys, if you're in YouTube and you haven't come over to the Trader Lab to visit, go to bookmap.com. Join Discord chat. You won't be solicited. You don't have to be a subscriber to Bookmap now, ever, never. Not the point. A lot of free education. Stocks, options, futures, order flow, loads of things you can access to help you get a better understanding of the market. And it's not just one way to do it. There's so many different ways to trade. But I think most of us go down the idea that complexity reveals clarity, and it's actually the opposite. So I think that might be something you might want to take advantage of. Come to the Trader Lab. Our senior trader has over 54 years experience, and then newer traders, of course, so it's very diverse. The other thing is we are leveraging our collective experience, because you and I and the others, we've all done the same thing. We're on different roads and different paths, but we're all on a similar journey. And maybe someone else's experience can maybe save you time and potentially dollars for going down rabbit holes that may be dead ends. I've certainly spent years in rabbit holes looking to make something work that didn't work, but I believed erroneously that it could work. So it was kind of like proving I just got to find the right way, or I just got to make the right, all that, right? We've all gone through that. So if you're still going through that, the answer might not lie in doing what you're doing, but in maybe finding other ways to integrate what you do into what you're doing, or not do what you're doing if it doesn't have a positive expectancy. And everybody's answer is different there. You know. So, and if you come over to the Trader Lab, it's a great community. And there's those PDFs that you're all welcome to. There's about 60 of them of different configurations that you can study. Also, there's a introductory video up there on auction market theory and the profile and just integration of these behaviors, which you might find, and will save you time. Whether or not you ever use any of this is, not material. But I think with a better understanding of how the market works, it'll give you maybe an advantage over our main competition, which is other retail traders who have no idea because they're going down the indicator rabbit hole thinking plug and play somehow is going to give them an ATM in the basement, which I suspect is probably not going to be the case. Again, past performance not indicative of future results, and you have to vet your own ideas, but by all means have a trade plan that you vet so you know statistically what your probability is of any outcome, so it's not random. Thanks for being here. Thanks for being in the Trader Lab. Appreciate all of you. And by the way, I continue these narrations in the Trader Lab and the Bookmap Discord Lab. So the audio stream will continue as circumstances dictate. I try to stay in touch. And again, thanks for being part of the Trader Lab. Just a note, I will not be here next week from Tuesday through the end of the week. I won't say I'm going fishing, but you might think of it that way. So, but I will be checking in. But there won't be a live stream. But there's going to be streams ongoing every day in the Bookmap Discord chat, so there's loads of education. So again, order flow, I think, especially, is a very confusing element. And what I have found with order flow, so you know, is when do I pay attention to it, when don't I? And that takes time. This is a specialty tool. And it's not, if you're used to plug and play, flip an indicator on, and somehow it doesn't work like that in the real world, So this takes a different skill to understand why this was important, why we came back here, why this liquidity showed up here. If you don't know the answer, then you don't understand order flow. And that's okay. The thing about it is, can you understand order flow? What separates this behavior from this, or this, or that? Why is this here? Why is this here? Why is this here? And what is the impact? Is this real? And are these guys going to pull and open the door? Now remember, I think the shorts are going to get squeezed. So what is real? Why did we react here? See, if you understand order flow, you might be able to put it together. But for me, order flow is not a triggering mechanism. This is the chassis that I build everything on in the developing time frame. The microstructure is the behavior that shows me what the participants think in all time frames. So I have, in a way, I can see microstructure that'll show me a counter rotation, but I have to overlay it on this because this is where the higher, the daily participants are active, and I'm attempting to work with the microstructure to get aligned with this for these rotations. And then let's go back again. Back again. I got to come back. I always have to come back to this. So it's microstructure inside a daily developing structure inside of this. That's what's fractal. So I can operate in all of this, but I can never lose sight of who's on the hook. So it could be these guys. And I use statistics, which kind of helps, which says just to me north, not a trade recommendation. Are you guys tracking? Is it logical? So that's it. Not complicated. If you make it complicated, you'll be in a state of confusion. Now, we are always in a state of unknown because rotations are random. I mean, how the market does what it does it do it, does it not do it? But the auction is giving us insight to behavior. What did we do? What did we not do? If this, then that. If not, then what? If we come down and mean revert and we can't take these guys out, and remember at the time, I don't know, so don't think I know anything. We come up, the volume shifts, key. We check retail here. No different than the micro time frame when we pull back to high volume. It's the same thing. It's all generic. Too low. Then what? Move away. Warning, Will Robinson. Potential mean reversion. I can't take it. Remember? Comes back. Doesn't quite tag it. Or does it? Right here. Too low. Then what? Potential squeezeteria. Then what? I think I lost it. Where's that overnight? This. And write it down. Not a recommendation. This 43.08 quarter takes out yesterday's high. So that is what our potential is. And again, it may not do it today. It may do it tomorrow. It may never do it. No idea. Doesn't matter because I don't know. That's it. Thanks for being here again. And Trader Lab, I will be visiting with you. So stay on the stream, stay in the audio, in the voice channel, and I will be there. A little later today, I have a little business to take care of. Thanks again, guys. We'll see you soon.